The wealthmanagement.com Advisor Innovations podcast is sponsored by LPL. As financial advice continues to evolve, LPL is at the forefront. Whether it's growing your RIA or building an independent practice, advisors can pick the business model, services, technology, and product mix that best meets their clients' needs. As a top wealth management firm 100% dedicated to advisor success, LPL looks forward to learning how they can help you build your tomorrow today. For information and show notes, go visit lpl.com/advisor innovation.
Hey everyone, thanks for joining us. This is the Advisor Innovations Podcast. I'm David Armstrong with wealthmanagement.com. This is, as you know, the podcast that gives me just an excuse, an opportunity to talk to folks in the industry who are pushing wealth management forward into new and interesting areas. And I think certainly today's guest fits the bill for that. Shirl Penney, the co-founder and president of Dynasty Financial Services. Shirl, thanks very much for joining us.
Thank you, David. I'm excited to be here. Appreciate the invite.
Yeah, absolutely. When we talk about advisor innovations, I think, Dynasty was on the forefront of a lot of this stuff. And I think, everyone knows Dynasty, I think. So I'm not going to spend a lot of time on it, but could you just take us back and, where you were when the idea of Dynasty popped into your head? What problems were you seeing in the wealth management industry that you were trying to solve? And why were you trying to solve them? What was the opportunity you saw? What was the problem you saw? Where were you back then, if I could throw you back that far?
Sure. Part of my, my background is I had helped build and then run the private wealth management business for a large brokerage firm, which no longer exists, a firm called Smith Barney that many of your listeners would probably recall. And sitting in literally hundreds, if not 1,000, end client meetings with the firm's top advisors, I just observed that the way that the ultra wealthy, these clients and prospects that were being brought in, especially those with family offices, the way they started to think about how they would purchase their wealth management advice was becoming more and more triangulated. And what I mean by that, they were getting advice from their family office completely separate from where assets would safely be custodied, and then separate again from where products were manufactured and sold. And they had basic technology, reporting technology, and the like that would tie that experience together for the advisor and for them. And I remember thinking, and David, this is probably 15 plus years ago, wouldn't it be great if we could democratize the triangulation of advice? If we could have $1 million client that was working with an independent registered investment advisor that had a scaled infrastructure behind him or her that could go out and pick any custodian that they like on behalf of the client, and then go out to any product manufacturer, whether it's asset management, credit, insurance, capital markets, and the like, and put that experience together in a similar way that what had been historically reserved only for the ultra wealthy. Wouldn't that accelerate the movement towards independence? And that was part of the early stage thinking of Dynasty. And we launched the business December of 2010. And since that time, we've onboarded over 300 advisors, 50 firms that those advisors represent, and now roughly $75 billion in assets on the platform.
Did you know back in the way that I think about this is that firms like Dynasty were basically freeing the advisor from the old traditional mode of being sort of the salesman at the tail end of Wall Street to independent business owners who could give fiduciary-based advice to clients. Was there a hunger for that at the time? Did you see advisors trapped kind of in the traditional Wall Street four walls looking to change? I mean, how did you know that there would be a demand for the services that you were going to offer advisors?
Yeah, it's a great question. And yes, the movement towards independence, again, we're going back now 15 years or so ago, had started. And you were seeing, I guess, what I would describe more rugged individualists, some advisors, early movers, pioneers that were going out and starting to launch their own businesses. But again, really being proximate with the end client, which is really kind of where the rubber meets the road in our industry, or frankly, probably most industries. What I was observing and hearing, again, was this desire to get advice separate from where products were manufactured and sold. And what much of the press has really, in some ways, missed, to be candid, over the last decade plus, is so much of the independent movement has actually been driven by the breakaway client as much or more as it has been by the breakaway advisor. And if you look at asset flows of the custodians, as a barometer, as an example, you look at literally hundreds of billions of dollars now that are coming into the RIA custody space, into the independent space, which is representative of organic growth of the RIAs that they support. That, on an annualized basis, actually far exceeds new store sales. New store sales are advisors breaking away from independent broker dealers, as well as breaking away from wirehouses and going to full independence. That number is much smaller versus the organic growth number. So we were seeing, by paying attention to the wires that were going out, they were going out on a more accelerated basis to the RIA custodians. And then once, the level of breakaway advisor started to match the demand of the client to get advice, more on an independent basis, layer on top of that innovation and technology and capital and maybe some other things that we'll discuss, you kind of have a perfect storm for why the whole independent movement has accelerated over the last decade plus.
I always thought of Dynasty as the landing place for the wirehouse advisor who was breaking away. Has that changed in recent years? Are you finding that there's less wirehouse breakaways and more RIAs changing from either an independent shop wanting to join up with a back office platform like yours, or maybe joining from another captured regional broker dealer or some other dynamic?
Yeah, look, I think Dynasty has done more billion-dollar breakaways than anyone in the industry over the last decade. And the result of that, those are exciting stories. So people get to know Dynasty as a firm that certainly can facilitate these larger breakaways. But the reality is we've also launched quite a number of firms coming from the independent broker-dealer channel that wanted more autonomy, more independence, maybe wanted to upgrade some of the technology or increase flexibility for how they grow, including inorganic growth with M&A, et cetera. And quite a number of our clients have come, to your question, David, from RIAs that are really looking to focus on their team internally or looking to focus on client service. They maybe don't want to so much juggle 45 different vendor balls. So they're looking to outsource more of their integrated technology stack. They want to leverage us for synthetic scale, meaning they get all the access to the personnel and talent that we have here without having to directly put them on their P&L. We've done some interesting research over the years looking at, if you look at where we sit today, the average RIA on our platform is north of $1 billion. And you look at RIAs that are not on our platform at similar size, what you find is those firms on average have 4 to 5 more personnel. So higher fixed cost, but also, people require, time to manage. And that's time that could be deployed, with clients and getting new ones. So we're seeing several hundred basis points of increased profitability for firms on our platform versus their peers, not just because we're able to save some money on the integrated vendor stack, if you will, which we call resource partners, but because we help on some of the fixed costs with personnel. And if you apply, multiples that you see in the space right now, which are really at all-time highs in terms of valuations on RIAs, we're able to help increase, I think, in a material way, the enterprise value of these firms as well. And because they have more time, because they're not managing vendors and people, they have more time to grow. So they grow faster, they're more profitable, they have higher enterprise value. And I think as that story is getting told more and more around outsourcing to an integrated end-to-end platform service provider like Dynasty, we are seeing a lot more interest coming to us from already independent RIAs that are really focused on rapid professionalization and that are in aggressive growth mode.
I'm going to bring you back to the beginning again. When you started this with, I think, Ed Swenson and there were some others in there, was there resistance? Did you detect any resistance from, the traditional players skepticism? What was that? What was the environment like? Or was everyone like, this is a great idea and I think it'll work?
Yeah, I wish it was that easy, right? But so this concept of having an integrated technology stack, and if you go back when we started the journey for the business, well over a dozen years ago, we were talking about open APIs and technology, which today is more kind of table stakes. Back then, it wasn't. There was still a focus on trying to have more things done on a proprietary basis, more of a strategic focus around captivity. With advisors and open APIs and open source, and those things were still very early on. So you mentioned Ed. I give Ed a lot of credit around our early stage technology strategy, which was to really focus our tech spend on integration. We wanted to become, I guess the analogy I would use is the iPad, right? The high end iPad for the elite RIA that could integrate and curate a suite of apps that could meet the need of the advisor today. But as they grew and evolved, and as the industry grows and evolves, we can switch out the apps to make sure that we're including best-in-class capability versus going down the rabbit hole and trying to do everything ourselves, which, over time, and you see this with a lot of the installed players today, you end up having 25, 30-year-old technology that is very difficult to innovate on top of. So we designed the business to be nimble in that way. But early on, further to your question, people really wanted to compare us to roll-ups that were out there, right? That were starting to acquire RIAs, and we kept, trying to go out and educate, the marketplace by saying, no, we are a integrated platform model where you can come and get all of your technology support. We have an investment platform. That's kind of a TAMP plus. So not only do we have SMAs and UMAs, but we have alternative investments in capital markets and access to lending and structured products and investment banking, a lot of things that historically hadn't been made available to RIAs. And oh, by the way, we have capital too, which is really more of an accommodation. It's both debt. We have debt programs, we have equity programs, but those are things that we make available to our core clients that are using us on an integrated basis for the first two businesses. And then we make the capital available to them. And I have to give a lot of credit, David, to our board of directors. We had, from the early days, I've been blessed with, people like Todd Thompson, who was CFO of Citi and ran the wealth business there. Harvey Golub, who's our chairman now, obviously, who had run American Express, and Jim Brown at Long Ridge, who's a personal investor, not through his fund, just has tremendous perspective in the space. Jerry Eberhardt, who's an old mentor from Smith Barney. I really could kind of go down the line, and we had a lot of debates early on around the business model with a focus on where are the gaps, what doesn't exist out there right now that advisors really want to ultimately help them take better care of their clients and build better businesses, and to do it in a way that was a bit capital light. We didn't want to raise a bunch of private equity money out of the gate for Dynasty and give up control. We really wanted to build a business that was more nimble, that would power entrepreneurs, that we could benefit from what I call positive selection bias, working with advisors that on the whole are a bit younger, in that they have a long runway in front of them. They don't want to give up their equity. They see their best years in front of them. And what can we do to make their life a bit easier, to help them, grow their businesses, be more successful, and as they win, we'll win alongside of them as a result.
Do you remember your first big win, your first big breakaway?
I do. Our first client was the principal was a guy named Alan Harder. He runs a company called Pactolus, and they're in the DC market. I had known Alan from years prior during our time at Smith Barney. So having that relationship certainly helped, because we're looking someone in the eye and saying, go ahead, jump out that window and trust us that hand chute's going to go up and it's going to work and you're going to have a safe landing. And we're going to be there every step of the way. as you take your life's work and transition it to a fully independent firm. It's a lot easier today, as you can imagine, with 75 billion, plus in client assets and countless, breakaways and moves later, than it was back then, where, we really, looked Alan in the eye and said, we'll figure this out together. And happy to say that, Alan is doing quite well. His business has thrived on the independent side, and still a client today. And he's very proud, I think, to say that he was client number one.
I mean, you guys are certainly on the right side of history in terms of the industry transition. It strikes me that it's the thing that doesn't stop, right? I mean, I guess I always imagine firms like Dynasty and others that are providing services to the independent side is kind of having to paddle fast. When do you think, well, okay, we've accomplished our mission versus advisors they constantly need more, right? They constantly more services, more, estate planning services, tax preparation services, concierge services for ultra high net worth clients, structured products, like you say, alternative investments, access to the types of investments that they could really previously only get as being part of a Wall Street bank. That's just more and more and more and more and more. How do you kind of make that work and keep the value proposition the same, right? I mean, so you're not charging them necessarily more, you're having to provide more. Where does that go?
Yeah, one of the things I like about our business model is the alignment with the advisor, right? The advisor has to stand and deliver every day on behalf of their client, or they'll be fired. We have to stand and deliver every day on behalf of our client, who is the advisor, or similarly will be fired, right? So that kind of daily accountability, I think, is very healthy within the business. But I will say part of what drives us, to innovate and evolve our business, really, if you take a half step back, we're thrilled to be in, I think, one of the most needed and essential industries in our great country. And we have a bit of a crisis that is continuing to unfold, in my view, which is the lack of financial literacy and financial health in this country. If you look more broadly, right now, we're at a moment in time where 75% of Americans can't put their hand on $1,000 in an emergency, and it's getting worse. It's not getting better. You look at what's happening with pension funds, endowments, the underfunding that has occurred, and I think fundamentally, the way that we get healthier, whether it's at the individual, state, federal level, companies, et cetera, it's by delivering world-class financial advice. It's not by selling product to people that they may or may not need. So we're really driven, by a much bigger mission, which is to help independent advisors thrive and do well, to tech enable them so that they can service more clients equally as well tomorrow as they service today. There is, and this is why I think it's an amazing time. And I would encourage anyone listening that maybe is transitioning from the military, retiring school teachers, wherever you might be, if you're thinking about getting into wealth management and financial services, please do it. We need you. And it's an amazing time to join this industry because there's a supply and demand imbalance. At a time when let's look at the macro demographics with baby boomers retiring, wealth creation, at a time when more and more Americans need quality financial advice, there's fewer and fewer advisors to deliver it. We've lost 60,000 advisors in the last decade, David, and no one in the industry, brokerage firms, IBDs, RIAs, there's no one that's really doing a great job at replacing them. So you went from, call it, 350, 360,000 wealth advisors now to actually below 300,000 over the last decade, when manageable, addressable managed wealth in this country has tripled. So it is a bull market for sure on financial advice. It is a time where it's critical to focus on financial literacy and financial health in this country. We need talent. We need scaled technology to help more people service more clients. And that's, why we fly out of the bed every morning at Dynasty is we feel like we're doing our little in helping to advance this most critical industry at a very, very important time in this country.
Well, let's talk about that bull market for advice for a minute. You launched Dynasty, I think, on the eve of the last great financial crisis. And I'm speaking to you today and it looks like the markets are well on their way to lows here. How much damage can the RIA industry withstand in terms of markets falling before changes have to be made or accommodations have to be made, whether that's removing some of the services that they offer or having to maybe let go of people or accommodating. I don't know what it would look like. I remember speaking to Peter the last time when this happened in the early part of the pandemic, when the markets fell apart, and he said, okay, 1 quarter, we're fine. 2 quarters, everything's going to change. That didn't happen then. What if it happens now? What do you see coming up in terms of the markets and what that means for the health of the RIA industry?
Yeah, well, first of all, I would say when you have volatility like we've experienced over the past, several quarters, it is a bit of an advisor's Super Bowl, meaning, the best advisors go to work and win on a disproportionate basis in an environment like this, right? When you have sustained, 11, 12, 13-year bull market where it seems like, markets are going up consistently over time, a little less choppiness, then that can breed complacency, both, by the way, on the part of the end consumer or the end client and the advisor. And what happens in markets like what we have now, more clients want to talk to their advisor. And those that are being proactive and very proximate with their clients are the ones that are keeping their clients. But then at the same time, they're going on the offense and they're talking, to other clients who are prospects for them. And, one of the benefits of what we get to do here at Dynasty is we're really supporting some of the elite top independent advisors in the country. They're entrepreneurs. They own their equity in their business. When the market is off, they go to work and they grow organically. They are talking, to more and more prospects than ever right now. And it seems like, daily my email is filled with great stories where, $20 million client, $50 million client, $100 million, not all ultra wealthy, some are smaller as well, but the amount of wins right now in this environment start to accelerate. The other thing, as I mentioned, complacency, and we're seeing this happen as well, is a lot of advisors in particular that were sitting at the wirehouses and maybe their income, even though their advisor comp may get slightly adjusted on an annualized basis, their overall income is going up because they might be growing, but also the market's growing as well. But in this environment, they're starting to call us and say, look, if we realize that if we want to continue to make an enhanced income, maybe we'll look to move to the side of the industry where we get to keep a larger percentage of our revenue and look to the independent side. So we've had quite an amount of inquiry in recent months where advisors just historically hadn't looked around, but now as they think about more flexibility for the client, maximizing income, and ultimately thinking about how they might think about succession down the road, they're finding that they'll have more flexibility to do it on the independent side. And the last thing I think I would say is I do think we're reaching a point where valuations with RIAs are starting to get stretched. These are amazing businesses. They have great annuitized revenue stream. They're most critical in terms of the service they provide, as we've discussed. But at some point, you're starting to flex in terms of what realistically you can pay for these businesses. And I do think you'll start to see an acceleration with M&A with a number of firms that maybe feel similar that I do, which is valuations maybe are at a high, and someone who's been waiting into the future for even higher valuations might suddenly say, you know what, let me go ahead and transact today. So I think that this pullback that we've experienced could be good for RIAs from both a organic and inorganic growth perspective for the reasons that I articulated.
Yeah, and it's not just the falling markets, right? It's also rising interest rates, and how much of the RIA boom has been fueled by private equity. I know you have some thoughts on that, and what does a rising rates, lower equity price combination mean for those deals? I guess we don't really know yet, right? We haven't seen a big exit, but what is your sense of the amount of private equity that's in the RIA space and what it might mean?
Yeah, I think, look, as a whole, the amount of capital that has come in over the last decade to the RIA space, I think has been quite good. It's obviously driven more attention to the space. And at this point, as I like to tell people, the RIA ecosystem is quite well discovered. And as I said, it's a great place to invest, not just in RIAs, but also in the ecosystem around it, with technology and product and service providers, platform providers like Dynasty. The rising tides within the RIA space have floated a lot of boats, that's for sure. But when you look at and you start to unpack growth and the importance of organic growth, in particular, as you say, in a rising interest rate environment where the cost of debt, as an example, will begin to rise over time. If you're acquiring businesses at a high price with a substantial amount of leverage, and you're not helping those businesses grow organically, you can become stretched over time. And we have historically at Dynasty, in fact, today, we have no debt. We've not levered up our business at all to make sure that we have maximum flexibility. But I think, I like to say to advisors, look, when you're thinking about selling even a piece of your firm, really understand the capital construct of the business that you're selling to and who owns them and what might be their motivation, what might be their challenges down the road. There's, a number of product providers that are out there that are buying into RIAs in part, to try to drive distribution of their product. There are private equity firms, obviously, that are in the market. There's public companies that are in the market. There are strategics. There are family office. I mean, there's so many options. I always like to remind advisors that, if this is your first time that you're having a conversation with a sophisticated financial partner, get yourself an advisor, whether it's a consultant, an investment banker, a lawyer, a tax professional, someone who does it all the time. I mean, you just really don't want to be on the field of battle, fighting against the Navy SEALs, figuring out how to shoot the weapons, while you're in the middle of the battle. This is what they do all the time. If you don't know, what a preferred return and picks and various, structural elements of a private equity investment is, then you're probably not ready to negotiate a term sheet with a private equity backed RIA. So make sure you're surrounding yourself with advisors that live in that space. And again, these aren't. I don't think that these are bad options. It's really about understanding the whole suite of options that best fit your particular need. But the last thing I'll say on it, it does surprise me. David, I fortunate enough to speak at a lot of industry events and love to attend various events for my own professional development. And inevitably, I'll find my way, to dinner or a bar or something in the evening with a group of advisors, and someone might be unhappy that they've sold a piece of their firm or sold all of their firm and they can't reverse it. It's irreversible. And they say, we wish we knew what we know now then before we made the decision. So it just underscores the importance of due diligence. And, advisors should do what they would tell their client to do. If their client was looking to sell their business, they would tell them to get an investment banker, to get the right group of advisors, to run a process. And let's just not have it be a scenario of the cobbler's shoes where we have to live out our own advice that we're giving to our clients as well.
Yeah, that's great. And I know we've got just a few more minutes here. I know we've got a deadline. We're going to get the hook. But I know that Dynasty has flirted with the idea of going public. Anything in the market that kind of changes that trajectory, or where does that sit?
Well, obviously, the markets have been quite volatile. I will tell you, we have filed our S1, and for us, we like the ability to perpetuate our business. In some ways, I say live up to our name, which is Dynasty, which means winning consistently, executing at a high level for a very long period of time. We like the transparency that comes with being public in terms of showcasing financial strength, of your partner. For advisors, whether they're outsourcing or breaking away, from an organization to launch their own firm, who they partner with matters a lot. And understanding the longevity of their partner. Will my partner be there not just for the launch, but to help me professionalize the business over time, and then ultimately help me think through succession planning and to perpetuate our business, to further align us with our clients, with the advisory firms, to help raise awareness for our brand and our business. I mean, our business more and more, David, is becoming from an ingredient perspective, very valuable to the underlying brands that we serve. And you see a lot of the advisors talking about their brand, powered by Dynasty. And as more and more end consumers look for an independent advisor, the good news is, there's more and more of them. The challenge is, how do I pick, which one? So I really see Dynasty becoming more and more the good housekeeper seal of approval, if you will, for independent advice, right? Look for an independent advisor, get your advice separate from where products manufactured and sold. Get one that's powered by Dynasty, right? Because they're going to have, strong access to capital and great technology and broad-based product access, strong compliance support, et cetera, all the things we want our brand to stand for. And we think making our way into the public markets will accelerate our ability to support our advisors to grow both organically as well as inorganically.
Final question. I know that Dynasty's gotten into the financing for advisor transactions. You have a capital purchase program where you can purchase 5% of a revenue stream, as some other programs moving into M&A. Anytime Dynasty going to become a owner of these firms? Will you ever acquire? Will you ever be a RIA owner?
Yeah, well, Dynasty, first of all, I would say is committed to being a B2B business. So Dynasty is unabashedly advocating for financial advisors, in particular, obviously, independent financial advisors. So we're never looking to compete with our advisors. We fundamentally believe that bad things can happen when you turn a great entrepreneur into an employee. So our capital programs top out at a 20% purchase of an advisor's business. It's really kind of that first bite of the apple to help them practice what they preach, in part around diversification. We can certainly finance some of our RIAs to acquire 100% of other RIAs, but we at the holdco are not looking to manage advisors. We're a wealth technology business first. We're an investment platform second, and a capital provider third. In terms of, in that order, in terms of size and scale of those various businesses. But because we've run the business, I think, in a way that really preserves our capital over time, we've been able to use, our balance sheet to support our advisors on various capital needs. We'll continue to do that. We've added investment banking expertise to the team to help our advisors grow inorganically. We've created succession programs to help the multi-generational teams with succession plans internally. But no, we'll not be out there acquiring 100% of advisors. It's just not our business model.
All right. Fantastic. Shirl, I know we're hard up against our deadline. Thank you very much for joining us. It's been enlightening for me, as always, and continued success.
David, thank you so much for having me.
And this has been the Advisor Innovations Podcast. Thank you for listening.
This podcast is sponsored by LPL Financial, a registered investment advisor and member FINRA SIPC. LPL Financial is a separate entity from and not affiliated with wealthmanagement.com.